again. So once again, good evening, everybody. So we are starting right away. So let me share my screen. Okay, can everybody see my screen?
Not yet.
Okay.
All you now did. I know no do this thing. Nobody's saying to do. Sorry, I forgot.
Can you see my screen now?
Yes, we can.
No class. No class. It's just
I'd like everybody to mute their mic. Please mute your mic, everybody. So once again, we are starting the class. My name is Anene Kalistus. I'm a chartered accountant and equally a financial modeling and valuation analyst. So today, I'll be taking you on a comprehensive lecture on IFRS 16 leases. So as per introduction, I'll be defining what a lease is, and I'll be explaining to you the various types of lease we have and what the standard is all about generally. So what's a lease? Now, let me explain it this way. A lease is a form of financing. And you know, you could get finance for an asset through debt finance, equity finance, and equally through lease. And so it's basically a form of financing. So a lease is an arrangement whereby the lessor, someone who owns a property or an asset, allows the lessee, the person who is renting the property, to use the asset in consideration for annual lease rental. Now, this standard is referred to as IFRS 16, but before IFRS 16, there was IAS 17. And under the operation of IAS 17, there were two kinds of leases. We have operating lease and we have finance lease. Now, let me explain the difference between a finance lease and an operating lease. Now, a finance lease is an arrangement whereby one person, the person who owns an asset, transfer risks and reward attributed to the owner, to the lessee, in consideration for annual lease payment. So what is lease all about? Let me break it down. Now, I want to buy an asset and I can't afford to pay on outright purchase contract. So I might enter into someone that has the asset to pay in instrumental, what we call lease rental, annual payment over the life of the lease contract. So like I said, it's a form of financing. And before IFRS 16 came into being, IAS 17 was in place. So IFRS 16 replaced IAS 17. So under IAS 17, I was saying there's finance lease and there's operating lease. So a finance lease is where a lessor transfer risks and reward attributed to the ownership of the asset to the lessee in consideration of annual lease rental. So what is it saying? If company A owns an asset and company B wants to use the asset, they'll enter into a lease agreement whereby the company that wants to use the asset will be paying a rental amount, will be paying a lease rental amount on agreed basis. That's what a lease is all about. So I was saying that, let me quickly go back. I said under IAS 17, we have two kinds of lease, finance and operating lease. But the reason why IFRS 16 came into to replace or supersede IAS 17 is because IAS 17 had certain limitations. It went against the definition of an asset and a liability. You know, in the conceptual framework in accounting, the definition of asset and liability as follows. Now, an asset is defined in the framework, the conceptual framework, as a resource controlled by an entity
as
as a result of past events,
from
and it is probable that a future economic benefit will flow to it as a result of that resource. So IAS 17 is saying that there are two kinds of lease, operating lease and finance lease. So according to IAS, sorry, this is supposed to be IAS 17. So what IAS 17 is saying is that if a property has a useful life of 10 years, and you lease it out for 6 years, then it is considered an operating lease.
Okay,
Why is it an operating lease? It's considered an operating lease because it is not for a greater part of the lifespan of the asset. So what I'm trying to explain is, I have a property. Two companies want to enter into a lease contract, and they have a property, let's say a motor vehicle, for instance, and the useful life of that motor vehicle, the useful life of the motor vehicle is 10 years. And the lease arrangement is that company A will be...
Hello, sir.
Yes,
Hello,
I can hear you.
Yes, please let everybody mute their mic. They're distracting the class.
Let me do it from my end. Let me do it from my end here. Please, everybody,
Yes,
mute your
you
mic.
are the host. You can mute their mics.
Okay. Can everybody hear me now? Can you hear me?
Yes. Yes.
Okay, so I was explaining of finance lease and operating lease, and I was saying that what a finance lease is simply is that if, based on this example I'm putting forth now, if you have a property, let's say a motor vehicle, and company A owns a motor vehicle, and company B needs that motor vehicle from company A, let's say a machinery, a particular kind of machine. Company A owns a machine, and that machine has a useful life of 10 years. And company B wants to make use of that machine. Instead of buying that machine outrightly from company A, they will enter into a lease contract whereby company B will be paying company A a certain amount of money, a certain amount called lease rental periodically over the life of the contract. So what IAS 17 that was before IFRS 16 came in says that if a property such as a PPE has a 10-year life, and two companies enter a lease agreement for 6 years, then that's an operating lease. So it is only a finance lease if the asset is leased for a substantial part or whole of the useful life. All of this is supposed to be useful life. I omitted the word life here. So what it's saying is, this asset has a 10 years life, but we are leasing it for 6 years. We'll consider it an operating lease. But if we lease it out for, let's say, 9 years, 8 years, 8, 9, 8, let's say 8, 9, 10, then that's a major part of the useful life of that property. It will be considered a finance lease. So that's just the differences between finance lease and operating lease under IAS 17. Now, IFRS 16 now came in to supersede IAS 17, and IFRS 16 is saying that there will be only IFRS 16 adopts a single lease model, meaning that irrespective of the number of years the asset is being leased out, is considered a finance lease. So under IFRS 16, all leases are considered to be a finance lease unless you lease out that asset for less than 12 months. So under IFRS 16, all lease contracts, except for lease contracts that have low value or are within 12 months, they will be considered as finance lease. So now, how do you identify a lease? Because if a lease contract is presented before you, maybe probably in an ICANN exam or an accounting exam, you need to be able to identify, is this a finance lease or is it an operating lease? Like I said, under a finance lease, the lessor transfers risks and reward to the lessee. Sorry, this is a typo error. Sorry, this is supposed to be lessee. I'll correct that. Lessor transfers risks and reward to the lessee, and the lessee has the right to exercise secondary option to buy the property. Now, let me explain. When a company owns a machinery and another company enters into a lease agreement to use a machine owned by another company. Now, once I'm in possession of that machine, I'm in charge of the risk and the reward has been transferred to me. Now, what's the meaning of risk and reward transferred to me? It means that I can generate benefits from the use of that asset, and I can incur loss from the use of that asset, and I'll bear the loss as I control the asset. So under finance lease, the lessor transfers the risk and reward to the lessor. The lessee has the right to exercise secondary option to buy the property at a price favorable to the lessor. Now, what I'm saying is, in a lease contract, when you lease out a property, you are receiving the lessor, the rightful owner of the property is earning rental income, or what we call lease rentals. And so at the end of the lease contract, the property returns back to the owner. But under a finance lease, there is a right to exercise a secondary option whereby the lessee, the person that wants to use the asset, can buy the property at a favorable price from the point of the lessor. Now, another difference is another point that points out that a lease contract is finance lease. The lessee maintains and insures the asset. So once the owner of the asset, who is the lessor, transfers the assets to the lessee in exchange for lease rental or rental income, that the lessee maintains the asset and insures it. Now, for operating lease, the lessor retains the risk and the reward. So the risk and the reward is still with the lessor under operating lease. And like I said, it is an operating lease. You will know if a lease is an operating lease where the lease arrangement is less than 12 months, or if the value of the lease is minimal. Yeah, somebody is raising their hand. Someone is raising their hand up. Someone's hand is up. Yes, you want to say something, sir? Okay. Now let me continue. Now,
sorry,
yes.
I want to ask something. You said the lessee maintains and insures the assets.
Yeah.
The lessee is the owner of the assets, right? And we said that in the finance lease that the lessee transfers the risk and reward to the lessor.
Yes.
So it should not be the lessor that will
No, I corrected. Sorry, there's a typo error here. This is supposed to be lessee. This is lessee here. Lessee here. I'll correct that. It's lessee. I don't want to switch my screen. I'll correct that. Now this is supposed to be lessee. It's a typo error. Lessor transfer risk and reward to the lessor. So that's that. So let me do a practical illustration. Now, so let me go back. So let me explain something now. Excuse just a minute, please. Let me correct something and come share my screen. Let me end. Let me quickly correct this. This is
your number. Your number.
okay. Okay, now let me explain something now. Okay, now we have company A now. Company A is the lessor. Now let me explain this using a diagrammatic illustration. We have company A called the lessor, and company A legally owns the assets. Now, we have company B that wants to use the asset, and company B is called the lessee. Now, the terms of the lease contract is that company A will be paying lease rentals or rental payments. Now, what happens next? Now, these rental payments can be in advance or it can be in arrears. That is at the end of the lease period. Now, we'll be focusing, we'll be looking at how to recognize lease contract under the lessee, in the books of the lessee. That's what we'll be looking at, because once company A leases out the assets to company B needs to recognize as it's an asset because it's now in control of the property that is rightly owned by company A. But in the conceptual framework, once you have control of an asset, then you have the right to recognize it. Because of the fact that you are controlling an asset, then a property, then it's right for you to recognize it as an asset. But under lease, you recognize it as right of use, because you have the right to use that asset. The asset is owned legally by company A, but you have the right to use the asset as company B because you enter into a lease contract. So you recognize a right of use asset on initial recognition, and equally recognize a lease liability in your statement of financial position. Now, let's look at how to recognize a lease transaction in the financial statement. Now, we have initial recognition, and subsequent recognition. Now, please pay close attention because this is where it becomes a bit tricky. Now, on initial recognition, at the start of the lease, the lessee initially recognizes the right of use asset and lease liability. So what am I trying to say? Company A owns the asset. Company O owns the asset. Let's say a machinery. And company B wants to use that machinery and does not have the capacity to do not. Please mute your mic. Okay, so I was saying that on initial recognition, we need to know how to recognize a lease transaction on initial recognition. Now, I was saying that company A owns a machinery and company B needs to use that machinery but cannot buy that machine outright. So you need to enter into a lease contract. So on initial recognition, the company B, that's the lessee, the company that is using the asset, will need to recognize right of use asset and a lease liability. Now, how do you recognize? Now, these are the various points to take note in recognizing right of use asset and lease liability. Now, you will measure the right of use asset at the amount of lease liability plus initial direct cost incurred by the lease. You know, the lease is a contract. So there are other attributable costs that are to be included in recognizing the value of the asset. You know, under property, plant, and equipment, in recognizing the value of a PPE or asset, you must take into consideration other attributable costs. So the same goes for recognizing rights of use asset under a lease contract. You will measure the value on initial recognition. These are the items that will make up the value of the asset, the amount of the lease liability, plus any indirect cost. Indirect cost might be cost of maybe any legal fees in setting up the contract, then estimated cost of dismantling, payment less incentive before commencement date. So these are all the items that you need to take into consideration in coming out with the value of the amount to be recognized as right of use asset in the statement of financial position. So how do you measure the lease liability? The lease liability is measured at the present value of the lease payment payable over the lease term discounted at the rate implicit in the lease. So now what we're trying to say is you recognize the lease liability and you take into consideration any fixed payment, less incentive, if there are variable payments, and if there's equally expected residual value guarantee, estimated cost of dismantling, penalty for eliminating, that's if you eliminate the lease before the contract is fully matured, then there will be a penalty for eliminating, and there's an exercise price or exercise option if reasonably certain. Someone is raising their hand. Please, you want to say something? Go ahead. Hello, Mr. Toyosi. You want to say something? Okay. Now, let's go ahead. Now, I said note, if the rate implicit in the lease cannot be determined, the lessee shall use the borrowing rates. Shall use the borrowing rate. So now, then under subsequent measurement, at the start of the lease, this okay, now this is not supposed to be here. Let me go back. Okay, this is not supposed to be here. Let me quickly edit this, then I share my screen again. Let me quickly go back. Okay. You can all see my screen, right? Can you see my screen?
Yes.
Okay. Now, I was saying that we are moving up to onto subsequent measurement. Now, under subsequent measurement, the right of use asset will be measured at the cost less accumulated depreciation. And now, take note. I want to point out that under a lease agreement, the property that is meant to be let, that will be leased out, might have a useful life of 10 years, but the lease contract is for 6 years. So we are going to be depreciating that asset at the lower of the useful life and the lease term. Now, depreciation, now I said that depreciation is based on the earlier of the useful life and the lease term, unless ownership transfers, in which case you use the lease term. So in recognizing your right of use subsequent measurement, you must depreciate at the lower of the useful life and the lease term. So if there's a lease contract where the useful life of the asset is 10 years, but the lease contract is meant to have a lifespan of 5 years, then you depreciate the asset using the 5 years. So the financial liability you recognize after initial recognition will be at amortized cost. Okay. That will be as amortized cost. Now let us look at an example. But before we look at the example, please. Is there anything that we don't understand? I could take it all over again. Is it clear to everybody, or should I explain again? Mr. Toyosi, your hand is up. Do you want to say something? Let me.
Hello, can you hear me? Can you hear me?
Yeah, I can hear you.
Yeah, so like I wanted to ask that in a situation whereby a company they lease their warehouse to
Okay.
company A, they lease their warehouse for company A for a year term.
Okay.
For a year term. In that situation, are we still going to recognize lease, or we are still going, since you mentioned the fact that once it is less than 1 year, we are going to recognize, we are going, there is a low value item that we are going to expense it, if I'm right.
Yes, I said if the contract is within 12 months, that means 12 months inclusive, then that's an operating lease.
Okay, but in a situation whereby it's just a year,
that's a year still too, it will still be an operating lease. Now, operating in the sense that it's within a year, that is 0 to 12 months, 12 months inclusive. If you are leasing out that asset for just 1 year, it still fall within 1 year. It's normal above. If it is 12 months or 13 months, that's out of 1 year, then it becomes a finance lease.
Okay, so in that situation, now you said in the initial recognition, we are going to recognize the minimum lease liability.
Yes.
So how do you now get the present value of that lease liability?
Okay, I'm going to give us an example now. We are going to look at a practical example. I think you get the question. So let's just follow this example. Before I explain this, that's what I said, before I take on this example, I'm going to look at it practically, so you see how to recognize it. But before I go to my example, I want to make sure everybody has understood my explanation. Is there anybody that has another question as regards to what I've explained so far? I could recap again. Anybody? Okay, fine. Now let me go ahead with an example now. Now let's look at this example. Can we all see my screen? Can we see my screen?
Yes.
Okay, thank you.
Yes.
Now, this is an example now. Example, on January 1st, 2022, Gamma Co entered into a 5-year lease of machinery. The machinery has a useful life of 6 years. The annual lease payment are 5,000 per annum, with the first payment made on January 1st, 2022. To obtain the lease, Gamma Co incurs initial cost of 1,000 in relation to the arrangement of the lease, but the lessor agrees to reimburse Pierre, that's the lessee. Now this is the lessee, 500 towards the cost of the lease. The rate implicit in the lease is 5%. The present value of the minimum lease payment is 22,730. Demonstrate how the lease will be accounted for in the financial statement over 5 years. And let me explain this question. Now, on the 1st of January 2022, Gamma Co, a company that owns a machinery, enters into a 5-year lease. Now, they want to lease out. Now, this is the rightful owner of this machine. Gamma Co owns a machine, and he wants to lease it out for 5 years. Now, we are told that the machine has a useful life of 6 years. Now, the lease contract is for 5 years, but the machinery has a useful life of 6 years. Let's take note of that, okay? Now, it equally says that to obtain the lease, Gamma Co incurs initial cost of 1,000 in relation to the arrangement of the lease, but the lessor agrees to reimburse. Okay, let me quickly.
You jumped something.
Okay, now let me correct this. To obtain the lease, Gamma incurs initial cost of this in relation to the arrangement of the lease, but the lessor agrees to reimburse. So now this is the lessee, and this is the lessor. So this is the person that owns the asset. Like I said, Gamma Co, but this is now the lessee. So it's that the lease contract is for 6 years, it's for 5 years. It's for 5 years, and the useful life of the machine is 6 years. So, and in the terms of the contract, it was agreed that the lessee will be reimbursed 500 towards the cost of the lease. So now we are told that the rate implicit in the lease is 5%, and the present value of the lease payment is 22,730. Now we need to account for this. How do we recognize this lease contract over these 5 years in the statement of the financial position of the lessee? We are interested in lessee accounting. It's what we're interested in here now. They are in the accounting books of the lessee. How is it going to be recorded over the 5 years of the lease contract? So let me switch over to my Excel. So I've created, so this is the template. I'm going to be sharing with you this template. I'm going to be sharing with everyone this template. Now the template is blank, so you can use it for any question. So I'm going to show you how to, based on the question we are looking at, how we are going to enter the this model. This is a lease model. So how are we going to enter that contract in this lease model? Now, let me go back to the question again. It is said that on the 1st of January, let me explain the question again. On January 1st, 2022, now Gamaco entered into a 5-year lease of machinery. The machine has a useful life of 6 years. The annual lease payment are 5,000 per annum, with the first payment made on January 1st, 2022. Now, to obtain the lease, Gamaco incurs a cost of 1,000 in relation to the arrangement of the lease, but the lessor agrees to reimburse peer. This is the lessee, 500 towards the cost of the lease. Now, let me go to my Excel. Can everybody see my Excel screen? Can everybody see my Excel screen?
No.
Not yet.
Okay, a minute, please. Okay, can you see my screen now?
Not yet. Okay.
Okay, now
Yes.
this is a lease model. Now, like you can see, it's a blank model, and we are going to be imputing figures on this model. Now, this is a by my right, you see a financial statement extract. Remember, we are told to show how we account or record for the lease in the books of the lessee for 5 years. So we have financial statement, the financial statement of the lessee. So this is supposed to be clear. I'll correct this before I send to you. So this is the financial statement of financial position. Remember, it's an extract. We're just speaking the aspect that has to do with the question. So this is the statement of financial position. So you have year 1, year 2, year 3, year 4, and year 5. So, like I said that in recognizing lease, there are 2 steps on initial recognition. Now, this is by my left, is initial recognition. This is what will enter our value for our initial recognition. So, like I said, when I was explaining, because this is a typical exam question, this is an exam question. So, if you are asked now, what's on initial recognition, what's the value to recognize as the asset and the value to recognize as the cost of the lease liability? So, on initial recognition, like I said, we'll recognize the present value. Let me switch again. I said on initial recognition, I'm going back to my Excel here. I said on initial recognition, recognize the lease liability plus indirect cost, estimated cost of dismantling, payment less incentive before commencement date. So I'm switching over to my Excel. So you can see my Excel screen, right? So the question says the present value of the lease payment is 22,730. So I'll come here, I'll put, this is debit and credit. This is on initial recognition. You can see my screen, right?
Yes, sir.
Yes.
Okay, so this is initial recognition. Let me put initial recognition here. Initial recognition. So I'll recognize 22,000. I'll debit 22,000. That's 22,730. 730. And I'll credit my liability with 22,730. Now, this is for initial recognition. Now, this is for initial recognition on year 0. But remember, okay, now, so this is the present value of the lease payment, that you debit the present value of the lease payment asset and equally credit it. Now, this will mean I'll need to put the 22,030 here, which is the present value of the lease payment. Remember, we said any indirect costs that is being entered into as a result of the lease contract will enter here. So in the question, we are told. Please let me mute. So we said in the question that on initial recognition, you must take note of the present value of the lease payment, any indirect cost. And we are told in the question that there was an indirect cost of 1,000. And the lessee, $500 was reimbursed to the lessee. So I need to put 500,000 here. So it's going to be this plus this minus this. Let me see if that's what my formula is giving me. Yes. So it's going to the present value of the lease payment plus initial direct cost less reimbursement. So this would be the value. This would be the value on initial recognition. But remember, we are supposed to depreciate this asset. So in year 0, which is the present value, the present cost of this asset is this, taking into consideration other attributable costs, which is the indirect cost, and minusing the reimbursement. So this is the value on initial recognition of the asset. But we are asked to do for 5 years. So this is like considered like year 0, if I may use that word. So, but we need to know. So by end of year, by the end of the first year, the asset will need to undergo depreciation. So we need to calculate our depreciation. That's how we got this figure. So so it's going to be 23,230 divided by 5 years. Remember the rule that the useful life of the asset is 6 years, but the lease contract is 5 years. So have it at the back of your mind. If you are depreciating a lease asset, compare the useful life and the term of the lease contract. So because the term of the lease contract is 5 years, so I'm depreciating on a straight line basis. So I'm taking this figure divided by 5. Remember, this is a model, so this is automatically calculating it for me. So I'm trying to explain how we got this 4646. So this will be our annual depreciation. So I'll come to my financial statement extract. I've drawn this already. So it's just for me to come and enter my figure. I'll come here, I'll put equals to, I'll refer to this figure here. Enter. So I'll do the same. So I'll just drag. So it means every year, sorry. No, this is supposed to be, let me link it. This is supposed to be this. So every year we have the same value. Let me drag. Okay, it doesn't give it equals to. So this is supposed to be equals to this. Okay, any questions so far? Is anybody the question of what I've done so I could recap?
I think I have a question. Can you hear me?
Yes, I can hear you.
Yeah, you mentioned the fact that we can only depreciate using the lease term if the owner is going to transfer the asset at the end of the useful life.
No,
That's what you said. That's what
No, I said for you in depreciating the asset, you need to know what the number of years I'll be depreciating the asset. Now I said the depreciation of the asset will depend on 2 things. You need to compare the useful life of the asset and the lease, the term, the number of years the lease contract is supposed to last. So the question says the useful life of the machinery is 6 years, but the lease contract is for 5 years. So I'll be depreciating this amount by 464. So that's why it's been divided by 5. If you were to see the formula, sorry.
Okay, so you mean that you must always compare the useful life and the lease term.
Yes,
the one
the
that
one that is
that's
lower.
what
Yes, the one that is lower is what you are going to use.
I've missed it.
And hello, sir, can you hear me?
Yes, I can hear you. I can hear you.
You also mentioned
Leasing companies, leasing is about
Any question, please. If you have question, let the question be addressed to me. Any question, please?
yes, we
Hello,
also
sir.
mentioned the fact
Oh,
that as regards to the implicit rates.
Yes.
Now, in a situation whereby in a practical, I'm going practical now. In a situation whereby a lessor rents a warehouse from a lessor, I mean you rent a warehouse from a lessor, and the rent is to be due in 2 years.
It will be due in.
How do you now get the PV of that particular rent to
Okay.
use?
Okay. Now in a lease contract, there's something that must be in the lease contract. If the lease contract says company A that owns the property is leasing out the property to company B that wants to use the property. Now, the terms of the lease contract must specify what's the annual rental payments. So in this question, I'm going to show you. Now, let me switch over. This question made it easier for us. They gave us the present value of the lease payment. Now, in another exam question, you will not be given this value. You need to calculate this, the present value of this amount. Right.
Exactly.
So you need to calculate the present value of the lease. So they have agreed that annually the lessee will be paying $5,000. It means it's 5,000 year one, 5,000 year two, 5,000 year three, 5,000 year five. That's the terms of the contract. But you need to discount this 5,000, and you need to be using what we call annuity formula. So if I was to use, let me quickly use the annuity formula. Let me assume that we are not being given that present value. Let me create a column here. Let me just quickly show you what you do. So I'm going to create a little table for you. Assuming you are not giving that, you are not giving the present value, you need to calculate it on your own. So what I'm going to do is I'm going to draw a small table. I'm going to use my MPV formula in Excel. So let me draw a table here. Let me just quickly add this. Now, I'm going to put here. So I'm going to put 1, 2, 3. I'll need to insert some rows. Let me insert some rows. So I have my here. This is here. 4, 5. Okay, this is. So this is 5. So I will now have my lease rental. So this is just my lease rental. So annual lease rental. Let me put this should be annual lease rental. So it means here. It means, please let me check to ensure I'm recording. I hope I'm still recording. Okay, recording is on. So now year 1, $5,000. Year 2, $5,000. Year 3, $5,000. Year 4, $5,000. And year 5, $5,000. So I'll now I'll put a formula to get my MPV. Now this is because I'm using Excel. Okay. Insert, sorry. So another thing now. Okay. So now I'll use my MPV formula here. So because this is Excel, if you were in an exam situation where you have a pen and a paper before, you need to use your calculator to punch annuity formula. Sorry, let me get this up. This is supposed to be 5,000. So I'm going to use Excel NPV formula to actually get this. I'll put equals to MPV. So MPV will be asking me what rates. Now they told me in the question that the rate implicit in the risk is 5%. So I'll put 5. So look at what the formula is saying. MPV rate, comma, value 1 to 5. So I'll select these values from here to here. And I'll click my enter. Sorry, let me see something. Value 1, value 2. Okay. Sorry, let me check on something. It's supposed to be Okay, MPV. Okay, I think I'm missing this formula. I'm missing this formula. Let me quickly use the one I know how to use, but the one. Okay, let me quickly explain. Maybe I'll get the right formula. There's a formula in Excel to calculate it, but what you're supposed to do is, this is an annual amount that is fixed every year. So what you're supposed to do is you use your annuity formula, and the annuity formula says you take 1 minus 1 plus R, 1 plus R. I'm trying to state the formula here. 1 into 1 plus R raised to the power negative n. Okay, this is supposed to be raised to the power n. Okay, raised to the power n. Now all that divided by R. So this is supposed to be divided by, oh no, let me undo. Let me just select, this is a cell. Okay, let me put it at the center. So you now put divided by R. So this the formula you are to use to calculate annuity. So I have my calculator with me. So if I was to use this formula now, it would mean that I will now multiply everything I have here. Everything here will be multiplied by, everything here will be multiplied by the lease, the annual lease rental. So let me explain how to use this formula. Now I'm being practical. Now let me use my calculator to do it. So if I'm to use this formula, 1 minus 1 plus R, the R is the rate implicit in the lease, that's the 5%. So 1 into 1 minus 1.05 raised to the power, for how many years now? For 5 years. All that divided by, please, 1 minus 1.05 minus 1. Please let me do the calculation, then I'll give you the figure. Okay, so using the formula, so this is supposed to, let me correct it. I've done it on my calculator. You can try that on your own. You will see that you get a figure close to this now. But the question gave us this value. So we are using this value. So this is the formula. You take 1 minus 1 plus R. That means if I was to do it, I'll say 1 plus 1 minus 1 plus R is the same like saying 1.05, because the interest rate in the list is 5%. So it's like saying 1 plus 0.05 bracket raised to the power, so raised to the power negative 5. So whatever answer I have, so I'm supposed to, it's a formula, so I'm supposed to put my equal sign before I start, equal to, so I'm going to say all that, everything here, so let me put a bracket, everything here now will be now divided by 0.05. I'll have a figure. So I have 4.41, but I have to now multiply it by by the annual lease rental, which is 5,000. So I'm basically taking this times 5,000. So this, if I was to put my formula here, I'm saying this multiplied by this. And it gives me 21,647. Now, but the question has made it easier for you. For example purposes, it's saying that just use 22, round it up to 22,730. So I don't know if you get my question. I got your question right now. Can you hear me? Yes, can you hear me?
Yes.
Yes,
Yeah,
yes, I can hear you.
Yeah, the person that
Yes.
asked the question, did you understand how we got that present value? No, remember this, I'm using the present value formula. Now, the present value formula, notice the MPV formula differs. If you have a cash flow, constant cash for a fixed amount of money for a given number of years, we are going to use what we call the annuity formula. So this annuity formula, because this, we are receiving a specific amount, is a specific outflow for a given number of years. So I'm using this annuity formula to be able to know the present value. So this is the present value of the lease rental. And that's the question we're asking, the present value of the lease payment. So this is, but the question says use 22,730 because this is an exam question. They want you to use this figure. Because some persons, where I get this or got this question from, some persons might be using 21.6438, some persons will just be around. So for uniform purposes, in an exam setting, they just assume that in a normal exam question, they might not give you this value. You need to calculate this value and you bring here. So that's how the model works. So once you have your present value of the lease payment, you add in indirect cost and minus the reimbursement. So you have this, the present value on initial recognition. So I'm now dividing by this to be able to get, if I divide by 5, I'll get my depreciation expense. Okay. Any other question? So before we continue.
Yeah, what if during the contract, the lessee spends additional cost, like for instance, now in repairing the warehouse, for instance, now in paying for the labor to repair the warehouse, or in fixing some factory some furnitures in the
Okay.
warehouse, or buying some other things just to ensure that the warehouse is in shape. Can
Okay,
that
that's,
be an additional cost to
yes.
the warehouse, or we are going to expense it? Or the
Okay,
only thing that will be the additional cost is just the agency fee or the legal fee that will be
okay.
added to the cost?
Okay, on when at the inception of the contract, every related expenses will be added to have the cost of the asset. Like we said here, there are other costs, indirect costs like 1,000. You will have other costs that makes up in signing up that contract. You add it up to get your amount. But any other expense that arise during the contract will be expensed. So here I'm capitalizing it. What do I mean by capitalize? To add every cost that is attributable to the contract on initial recognition, I'll add it to this initial lease payment to be able to get what will be the value that will be on initial recognition. So if I get your question, any other expense after the lessee must have been using the asset, let's say incurred things like repairs, those expenses will go to selling administrative expenses. They won't be capitalized in the value of the expense. They are going to fall under other expenses in your statement of profit and loss. The only time you add the expense to the present value of the lease payment is only on initial recognition. I don't know if you get my response. Did you get that? Hello, can you hear me? Hello?
Hello? Hello?
Hello? Yes. Yes, I can.
Hello?
Yes.
Yeah. That means the same goes for insurance.
For insurance. Okay, I did not get your question. Please rephrase your question again. I didn't get your question, sir.
I mean,
For insurance, I cannot hear you. I can't hear you. Okay. Okay. Can anybody hear me?
Because normally insurance is supposed to be at the initial stage.
Yes, the initial stage, yes, is because you see, yes, if there was insurance, if the lessee incurred insurance costs at the initial, when they were signing the contract, at the initial stage of the sign, it could be part of this 1,000. Remember, I said any initial direct cost. So this direct cost, $1,000 is might be made up of different things. I'm just putting it there, but you need to add up any cost that is attributable related to signing that contract needs to be added to the present value of the lease payment. Then if there's any reimbursement, you minus it. So I'm taking this plus this minus 500. So is that clear?
Yes.
Okay.
Yeah, hello, sir. What
Yes.
if in practice, still in practice, that R that you use as the interest rate,
Yes.
is it the normal bank interest rate? That's what you are going to use just to
Yes.
get the present value of the lease liability?
Yes.
Or what kind of interest rate you are going to use?
In the contract, it will be specified. You know, it's an agreement. So when they are signing that contract, they might decide, let's use the borrowing rates. I made mention of it. Let me go back. Let me show you something here. I said, note, if the rate implicit in the lease cannot be determined, the lessee shall use their incremental borrowing rate. So the rate will be agreed at the inception of the contract. Two things must be agreed: the rates that of the rate implicit in the lease and the annual lease rental. Those two things will need to be agreed. So those will be agreed on signing the lease contract. It will be agreed. So we've done that. So now, how do we know our value for year one? So this is what we're going to do. We're going to take this value now, which is the cost of the asset. So I'm going to link it, this minus our depreciation. So I'm going to be minusing, let me see, it's going to be this minus depreciation for year one. Okay. So this will be our right of use assets for year one. How do we get our lease? How do we get our lease liability? Lease liability. So they say, like I said, on subsequent measurement, your financial liability will be measured at amortized cost. So there's a table called amortization table. Please, I'm going to take time to explain this table, please, if you don't understand. So this amortization table, this same table works for when you take a loan in a bank. This is how it is being amortized until the life of the loan, until you expire, until you complete the payment of the loan. So this is an amortized schedule for lease liability. So it's from this table we'll be carrying our figure to transfer to this financial statement. So all the figures we'll be getting for our lease liability here, we'll be getting them from this table. So let me explain this table step by step. So we have years, which is the 5 years of the lease contract. We have the balance brought forward. Now, this balance brought forward now, the balance that was brought forward into year one was the 22,730. Am I right? The amount recognized on initial recognition, this amount. Now you are taking this amount, not this total. You are taking what was recognized here. For the right of use asset for year one, you add up attributable costs to this 22,730. But for amortized schedule, you pick your present value of lease liability. I stated it on my presentation. I made mention of it. Let me quickly switch over to my presentation again. So you can see my screen. You can see my PowerPoint. I said on initial recognition, it's measured at the present value of the lease payment over the lease term. So it's the present value we are using. So we will come to this table now. You can see my screen, right? My Excel screen, right? Can everybody see my Excel screen?
Yes, sir.
Okay, so like I said, on initial recognition, recognize this amount. Now, what's the cash? What's cash here? You know, you are paying, the agreement is that the lessee will pay 5,000 every year. Every year. So the first 5,000 will come in here. So what will be the outstanding balance? You had this as your liability in year one. As a result of that lease contract, you have paid the first lease rental. So the amount that is going to be left is going to be this amount minus what you have paid. This will be your outstanding capital balance. But remember, interest will accrue. And so how do we get our interest? Remember, the rate implicit in the rate is 5%. So I'm going to take 5% multiplied by this figure. So it's going to be equal to this multiplied by 5%, which is 5%. So this will be my interest. So what will be my amount carried forward? So the amount carried forward now at the end of year one is going to be this amount plus the interest. So this figure now, because this is a model, these two sheets are automatically linked. This 887 will go to statement of profit and loss, will go to P or L. This will go to P or L for year one. Let me put that in red. This will go in P or L for year one. Why this amount carrying forward will go to statement of financial position. Let me put it S. This will go to statement of financial position year one. So if I switch over to financial statement, you see that some figures have automatically entered. You see this has automatically entered here because I linked the sheet. The model, this is a model. So a model is simply an Excel sheet that has been linked in terms of any financial treatments that you are doing. So this is a model I got so that you won't need to be going back and forth. So because I've done the calculation here, our interest automatically has appeared here, year one, and our liability. So what will be, remember the question says, how are you going to account for this lease contract over the 5 years of the lease contract? So my lease payment, this is cash flow statement here, is going to be 5,000, 5,000 all through. It's going to be in jacket because it's a negative figure. It's going to be 5,000. So it's an outflow of 5,000, 5,000 for 5 years. So this is that about my cash flow statement. Now let's go for year two. Year two now, we are interested in the lease liability. What happens? Let me go back first. What can you see my Excel screen? You can see my screen, right?
Yes, sir.
Okay, let's go back to so what will be our asset now? Our right of use asset for year two is going to be this figure, which is the carrying value at the end of year one. We'll now subtract it from minus it from this depreciation because it's going to be depreciated. We'll minus it from we'll depreciate it. So this is going to be this minus depreciation expense. This will be my value for year two as right of use asset. Mr. Paul, your hand is raised up. You want to ask a question?
Okay, sorry, sir. This lease liability.
Yes.
I thought you said that. I thought you said that we are using this thing. That we are going to use only the lease liability, while the lease, why the one that is right of use assets to be different from the lease liability, right?
Yes. So what's the question
Okay,
now?
that's why there's a difference. Is that why there's a difference between the lease liability and the right of use assets?
Yes, there's a difference. On initial recognition, the lease liability is this amount, the present value of the lease payment. But the right of use asset on initial recognition is not only going to be the lease payment, it's going to be both other indirect costs, attributable costs that makes up, that will be added to the right of use asset. So this is like year zero. When I talk of present value, I'm talking of now, when that contract is being signed. At the moment of signing the contract, this will be the value you recognize as right of use asset. This plus this minus this. But on initial, for liability, you don't recognize this, you recognize only this. So that's why you see the value comes in here. This is at the end of year one, this is the value. This is at the beginning of year one, this will be the lease liability. Like I said, you paid 5,000, which is the lease rental. This is the amount that is left as your liability. Then you now have to add interest to be able to get your carried forward. So this will be your liability at the end of year one. I don't know if you get. Does that answer your question, Mr. Paul? Okay.
Yes, sir.
So now year 2. So year 2 now, this will be carried forward to year 2. So this figure will now come in here. So I'm going to put equals to, this figure comes in here. So this will be your brought forward for year 2. Your ending value of year 1 will be your brought forward for year 2. So again, you will still pay the 5,000 annual lease rental. So your outstanding balance is going to be this minus this, which will give you your outstanding value. Then you still incur interest again. So the interest is going to be equals to this times 5%. Okay, Mr. Paul, I can see your hand raised up. You have a question?
Sorry, sir.
Okay.
When we are doing this, we use depreciation, but yeah, you're calling it amortized schedule. So
yes, this is amortized schedule. Now, this schedule is helping me to know what I'll recognize in as my lease liability. I'm done with depreciation. I said for depreciation, this is the value on initial recognition. So I'm depreciating by 5 years. So if you depreciate by 5 years, this is the figure 464. This depreciation is a straight line basis. So this is going to be depreciation expense for the next 5 years. Did you get?
yes, sir.
So what we are using this table to is for us to know our liabilities. But like I said let me switch over to my presentation. I said on subsequent measurement, I said, how do you recognize your liability on subsequent measurement? I said financial liability will be recognized at amortized cost. So that's what this is trying to explain on subsequent measurement. So let me go back to my Excel. So now we've calculated 5% on this outstanding balance. So it's going to be added to this. So this your carried forward figure is going to be this plus this. This will be at the end of year 2. If I go back to my financial statement, under year 2, you see these figures automatically appear because the two sheets are linked. So if you come here, you will now see 681. Another liability, you will now see year 2. You are going to see this figure. So let's complete our table now. Right of use asset year 3 is going to be this figure, the carrying value at the end of year 2 minus your depreciation, because the asset would have depreciated at the end of year 2. So minus this. So this will be my value of the carrying value of the right of use asset in the lease contract at the end of year 3. So let me go how do I get my liability now? Let me go back to my liability. So my liability now, this is the carrying value of liability at the end of year 2. It's going to be the brought forward value at the beginning of year 3. So at the beginning of year 3, there will be another payment of an lease rental again, 5,000. So it's going to reduce your outstanding balance going to be this minus this. This will be the value outstanding, but you are going to calculate interest on it. So I'm going to say equals to this amount multiplied by 5%. That will be the interest. So what will be the your carrying amount, your carried forward liability will be simply be this plus this. So in year 3, if I go to year 3, I'm under interest expense. This will be the value of interest expense in year 3, and this will be my liability in year 3. So if I go, you'll see this figure and this figure. Now, then over to year 4. So the carrying value, the carrying forward liability of year 3 will be the brought forward balance in year 4. It's going to be the brought forward balance in year 4. This. Then you pay. Then we now pay now minus our annual lease rental. So it's going to give us this minus this. So what will be our interest payment now? Is going to be this multiplied by 5%. So this will be our interest payment. So what becomes our liability is going to be this plus this. So this will be our liability at the end of year 4. So if you come to our statement of financial position, our liability has come, our liability figures has automatically been pop up, and our interest expense. So what becomes our right of use asset in year 4 is going to be carrying value at year 3 minus depreciation expense during that year. So I'll now have this minus this. So I now have this now. So we have the last year to run now. So we'll go to our amortization table. So this value will be brought forward. This carried forward liability at the end of year 4 becomes the brought forward liability in year 5. So we now minus our lease rental. You see now it becomes 0. It becomes this minus this. So your interest automatically will be 0 because 5% of 0 is 0. But let me just put equals to 0 equals to this times 0%. It gives me 0. So what becomes your carried forward figure? It's going to be this. So plus this. So at the end of you would have completed the payment of the lease contract. So if you are doing this table and at the end here, you don't get 0, it means your schedule, you got it wrong in your amortization schedule. You got it wrong in your amortization schedule. If you don't get that figure. So we come here, so year 5. So year 5 is going to be this minus, okay, it's going to be, sorry, let me undo. So year 5 is going to be the carrying value in year 4 minus depreciation expense. So it's going to be remaining, the right of use asset is going to be 0. So this is going to be 0 and everything will be 0. So that's that about lease. So I think at this point, I want to open room for questions. I could explain if there's anything that anybody did not get, I could recap. So are we all clear? Is there anybody that didn't get, so I could take it again? Any questions? Can you hear me?
Hello?
Yes, I can hear you.
I was disconnected during when you started the carrying amount.
For
I
where?
lost to network.
Okay, when I was doing
the carrying amount. When we were through with the issue of depreciation, and we started with the carrying amount.
Okay, on this table. Okay, you were not here when I was doing this table, right?
No, okay. I wasn't there.
Okay, I'll redo. Let me do it. I still have time. Let me redo the table again. So I'm going to delete everything. Let me delete everything and take it over again. Okay, if I go back, my financial statement would have deleted so many things. Okay, let me start from year 1. I'm going to be a bit fast now, but you're going to get it. So you understood how we got this our depreciation, right?
Yes.
Okay, now we said to get your right of use asset in year 1, let me call it delete this. It's going to be equals to this amount on initial recognition here. So I'll link it minus your depreciation, because at the end of the year 1, the asset would have depreciated, right? So this amount minus your depreciation. This is how you got your right of use asset for year 1. Did you get? You get that, right?
Yes.
Okay. How do we get our liability? I'll say for liability on this table, what will be your liability at the beginning of year 1? Is going to be this amount you recognize at initial recognition. This amount, remember, on initial recognition, right of use asset was present value of lease payment plus initial direct cost minus this. But for lease liability, on initial recognition, recognize just the present value of the lease payment, which is this. So I'll bring this figure, will be my opening balance for year 2, for year 1, 730. Then Remember, the lessee will be paying 5,000 as lease renter. So you put your 5,000 here. So what happens is you're going to take, this is your liability at the beginning of year one minus your lease renter. So your outstanding liability is now going to be this minus this. This will be our outstanding liability. But remember, you have to pay interest. So you're going to calculate 5% interest on this. You're going to say equals to this amount multiplied by 5%. So this is going to be your interest. This interest is your interest expense for year one. If I go back to my financial statement, you see that it has automatically appeared here because the sheets are linked. Did you get that?
Yes.
So what becomes your carried forward liability now to year two is going to be this, because this was your outstanding, but you now had an interest that accrued that added their value plus this. This will be your liability for at the end of year two. So this figure is what is going to appear in your liability section as your lease liability under statement of financial position. That's why you are seeing it here in year one.
Okay.
So what happens in year two? Year two, this carrying amount will now become the brought forward amount in year two, because it will be carried forward to year two. So it's going to be equals to this amount. Then you will equally in year two still pay the release renter again of 5,000. Remember, the agreement is to be paying 5,000 as lease renter for the next 5 years. So after paying the 5,000 in year two, your outstanding balance is going to be this minus this. This will be your outstanding balance. You are equally going to pay interest. Interest would have accrued. You now calculate, you now say this multiplied by 5%. So what becomes your carrying forward liability now is going to be this plus this. So if I switch over to my financial statement, because this is a model, this figure will appear in my statement of financial position, in its profit or loss, and as interest expense for year two. This will be my liability for year two. So let's see. You see, interest expense, this liability. So this is a model. So a model means as the schedule is linked to the financial position. So in an exam setting, you would have drawn your statement of financial position like this, put year one, year two, year three, and be doing the calculation and be bringing the figures. But because this is Excel, so while I'm doing my calculation there, Excel is transferring it to my statement of financial position. So that's why it's called a model. So now let's go back to year three. So what happens in year three? Your amount that was carried this amount will now be carried forward now. Will now be the amounts that will be brought forward in year three. So I'll now minus my 5,000 again, annual lease payment, which we are paying. So this will be equals to this minus this. So this is going to be so what is going to be my interest now is going to be this multiplied by 5%. So what will be our carry forward? So we are going to take this amount of outstanding plus the interest that are accrued on it. So it's going to be this plus this. This will be my carrying liability at the end of the year, and this will be my interest expense during year three. So like I said, automatically the figures have appeared here. Now, our asset, let's come back to our asset. For year two, how do you get an asset for year two? It will be the closed carrying value in year one. So this is equal to this. It will equal to this minus, because it would have depreciated, minus depreciation for year one. It's going to be this. So year three is going to be this amount minus depreciation too. Minus depreciation. So we have first 3 years now. So let's go to our amortization schedule and complete for year four. So the carry forward figure in year three, this will be the amount that will be brought forward in year four. So this will be equals to this. Then our annual lease rental of 5,000 again. So we are now going to have an outstanding liability because we have paid 5,000. It's going to be this minus this. So an interest will accrue again. You normally calculate your interest again. So it's going to be this multiplied by 5%. Okay. So what becomes our outstanding liability now? This plus this at the end of year 4. So if I go to my financial statement, interest will be 238 for interest expense in year 4, and carry forward liability will be 5,000. So this will be brought forward to year 5, 5,000. You will now still pay your lease rental. So it means that your carried amount is now going to be carried outstanding balance is going to be 0. But it's going to be this minus 5,000 minus 5,000, which is 0. Automatically your interest becomes 0. It means your carried amount becomes 0. So at the end of the lease contract, you are supposed to have a carry forward liability of 0. It means you have completed the purchase of that asset, because it's not a purchase, it's a lease. You have completed the lease payment. So by the time you complete the lease payment, it's expected that your liability will be 0. So if I come to my financial statement here, my liability is automatically completed. Yes. So my right of use asset is going to be this, minus depreciation expense. Like what for year 5 is going to be carrying value in year 4 minus depreciation expense. So at the end of 5 years, your asset value will be 0, lease liability will be 0, interest expense will be 0, but your lease payment remains 5,000. So that is that. Remember, this question said that it is because the lease payment is paid in advance on the 1st of January. Let me explain something to you where the lease rental is paid at the end of the year. This is how our table is going to be structured. If it is paid at the end of the year, let me copy this table. Let me recopy this table and show you if it is a question you're asked. Because the agreement is that the lease rental will be paid at the beginning of every year. So what happens if the contract is that lease rental is paid every year? So I've just copied and pasted. What we're going to do is we're going to what's going to happen is the first column will be your brought forward balance, but you must first of all put interest first. So if the lease rental is paid at the end of the year, it means your opening balance will first of all incur interest before you pay your lease rental. So here is going to be interest payments. I won't complete the table, but I'll teach you how to complete it. Just if the question says the lease rental is paid at the end of the year, so you incur interest first, then you now have your balance. Then here will now be the cash. This will now be your cash. So everything here will be 5,000. I think I can quickly do this. It's going to be 5,000. But I'm going to change some of the formulas. 5,000, because here the lease rental is paid at the end of the year. The original question said is being paid in advance. So what happens here? So what's going to be our interest? Let me delete this. So this amount will first of all incur interest. So it's going to be this multiplied by 5%. So if it has earned interest, then what is going to happen is going to be our outstanding balance is going to be this plus this now. So I'm going to change this to be this plus this. So this will be our outstanding balance. Then you now pay your lease, you now pay your, how do I call it? I hope it's not changing my state. It's not changing because it's not linked. But I'm just showing you what you would do, assuming the question says your lease or the contract says the lease liability is paid at the end of the year. So it's going to be this now. Your carried forward amount is going to be this minus, what am I doing? Okay, this is supposed to be 5,000. This year is supposed to be going to be equals to this minus 5,000. This will be your value at the end. So this value comes in here. You now calculate interest again. Interest accrued, then you now add the interest to this. This is let me just leave it the way it is. Add interest to it. It's going to be this plus this. So this will be your outstanding balance at the end. So you now minus your lease rental. Okay, 5,000. Yeah. So this is supposed to be this minus. Oh, let me go back. So this is going to be minus this. So this will be your balance at the end of year 2. So it now comes in as year 3. You now calculate your interest on it again. Your interest will be calculated on it again, 5%. So it will now be deducted from this. It will now be added to this, sorry. It's going to be this plus this. So it becomes 15,550. You now minus your liability. So it's going to be this. Oh, let me undo. So it's going to be your outstanding balance minus your liability, your lease rental. So this will be your brought forward figure for year 4. You now apply your interest again. So I'm just explaining what happens because these are 2 scenarios I've painted now using the same question. So this will now add up to this. So it's going to be this plus this. You have this. You now minus your rental. Oh, yeah, undo. So your carrying amount at year 4 now is going to be this minus, this formula is not correct. So this is 5,000. Here is going to be this minus your amount you paid. This is going to be your carrying amount. So this amount will come as year 5. This amount will automatically come here. So I'll now take 5% of that amount. So this is the amount. You now minus this. Then we'll now add up. This will now add up to this. This will now add up to this. This will now be this plus this. Okay, so your outstanding amount will now be this minus this. Okay, why it's not exactly 0 is because this question was tailored. The question was tailored in such a way that it's because the interest is being, you pay the lease rental at the beginning in advance. So this will not apply in this question. But in case they set up a question and I said you are paying the lease rent at the end of the year, this is the format you follow. Normally, in a question in a question that is meant to be such that the lease rental is paid at the end of the year, is going to come out with a 0 amount of lease liability at the end of year 5. I can see Mr. Ogun, the most hand raised up. You have a question? Go ahead, sir.
Oh, good evening. It's actually lady.
Oh, okay. Good evening, ma'am.
Thank you for the session, sir. I just want to ask about the depreciation.
Okay.
In this kind of question, is it possible we use any method of depreciation?
Okay.
Like the annuity, the straight line, or all that?
Okay. Now let me read the question again now, so that let me share my screen. Now it says on January 1st, 2022, Gamma Co entered into a 5-year lease of machinery. The machinery has a useful life of 6 years. The annual lease rental is 5,000 per annum, with the first payment made on January 1st. That means it's an payment, the lease rental is made in advance. To obtain the lease, Gamma incurs initial cost of this and agrees to reimburse PF 500. The cost. Now, once the question is silent, you are using straight line. That's what I want to point. Do you get me?
Yes, I can.
Yes, once the question is silent, use a straight line in depreciating. So straight line means there'll be an equal amount of depreciation expense for that 5 years. But if it is said otherwise, then follow what is being said there. But when this question is silent, you are using a straight line or the contract. This is like I said, this is an exam question. This is an ACCA question I use to explain lease, because I felt it'll be easier to understand. So I think it's an easy question. So that's that about lease on the side of the lessee. So I don't know if there's any other question for any other question. Okay, do you have any other question? Okay, so if no other question, we have like 18 minutes to go. So we're going to end here. Maybe a subsequent. There are a few more things I would have liked to say, but this is a 2 hours class. I want to keep it at 2 hours. There are a few other things about lease that I would have added, but let me keep it at 2 hours so that subsequently, but feel free to send me a WhatsApp message if you have questions, maybe past questions on IFRS 16 lease that you felt you want to share with me to be able to answer. So feel free to drop on my WhatsApp or DM me on WhatsApp or send me a message. Then I'll explain, attend to questions, maybe exam questions or so if you have. So we'll look at that. So thank you very much. Is there any other question before I end the call? Any other question?
Yeah, good evening.
Okay, good evening.
Please, I want to ask, do you have like a schedule someone can be used, someone can use to compute all this lease liability and the interest and the same thing?
Okay, I drafted this schedule myself. I drafted this model myself. Now, I'm going to share this with you. I'm going to share this schedule with you. I'm going to share it with you, both the one that is blank and the completed one. So completed one is for you for reference purposes, to go back to what I said during the lecture. But the blank one, you need to be able to look at the situation you have on ground in the lease contract. Like this question is based for 5 years. You might use this template. You need to add, if your question or the situation you are using, you want to create a model, a lease model, your own is 5 years. You need to add additional years here. You need to add year 5, year 6, year 7, and so forth. And equally make sure you format the template, because like I said, this template was structured by me. So if yours is continuing, the lease contract is like, say, 8 years, it means you see year 6, year 7. You need to be very careful in linking your sheets so that it'll be giving you the figure automatically. Because if you have like a 20-year lease contract, it means year will continue to be year 5, year 6, 7, 8, and so on until you get to 20. Likewise, your amortized schedule. So, but I'm going to share this with you. It's so you can customize it to suit your situation, maybe the lease contract, or maybe you want to create a model for a lease contract. You can use this schedule, but you need to customize it based on the terms of the lease. That's what I'm trying to say. So I'm going to share. Somebody say, please, can we have the recording? Sure, you have the recording. Whatever I've said from the beginning, you can watch the recording again and ask me questions. So I'm going to share the recording. Likewise, I'm going to share both the completed template and the blank template so that you can use for reference and for learning purpose. Is there any other question? Any other question? Okay. Yes, does anybody have a question?
On the financial statement extract.
Okay. Yes.
Yeah.
Yes,
I think the right of use, and then we have another rule for the lease liability under.
Yes.
And I see that like where we have 18,584, then we have 18,617,
yes.
Then year 2 we have 13,938, then
Yes.
14,297. Are we
Yes.
depreciating each of them progressively?
Yes, we depreciate. No, what happens is, this is how we are moving. At year 1, we got this. How did we get this? We take this amount minus depreciation.
Yeah.
You know, you take carrying amount minus,
Yes.
you take cost minus depreciation, you have carrying amount, right? So year 0,
Yes,
this was the
yes.
cost minus depreciation, I have this. If I click on it, see that it is linked. This minus depreciation. So it's giving me that. So this minus this now. So this one is going to be cost in year 1 minus depreciation in 1 to give me carrying value in year 2. So it's going to progress like that. So year 3 is going to be, so by the time I take this carrying value in year 2 minus depreciation in year 2, I'll have this.
Yes.
So does that answer your question?
Yes, but for the lease liability.
Yes, the lease liability was gotten from this amortization. The lease liability is all these figures you are seeing here.
Okay.
Yes, so it's automatically linked. As we are calculating it here, that figure is dropping in the financial statement.
Yes, I understand now.
Okay, lastly, let me explain something for exam purpose. This is lease liability, but liability can be, in case you are asked in an exam setting, split the liability into current liability and non-current liability. How do you split this? Let me just quickly add a table here. Now you see something. Let me quickly explain this. If you were to break this into current liability and non-current liability, your current liability is what is expected of you to pay every year, the 5,000, right? The non-current will be this minus the 5,000. Going to be this, going to be this minus 5,000. No, sorry. That's this one. It's going to be, what I'm trying to say is going to be equals to this. I don't know why this thing is not paying. Oh, let me just, it's just going to be this minus this. That should be 13,618. So I just needed to point this out because in an exam question, they will say, show what will be the current liability for each year. So you just be splitting it. So throughout all the years, your current liability will be 5,000 because you are expected to pay 5,000 at the end of every year. So it becomes a liability for you every year. Then the outstanding figure, but the difference now becomes your non-current liability. So any other question?
But this applies to the advance if you paid in advance. Because
yes, in advance. It applies in advance. The only thing is your figures here will be changing. These figures was because the question, we got these figures because we're following the schedule based on the terms that the lease payment is paid in advance. If it was in arrears, these figures automatically change. It means your current liability will still remain 5,000, but what will change will be your non-current liability. Did you get? Hey, the person that asked me the question, did you get it?
Yeah, I got it. Thank you.
Yes. So if there's no other question, I believe there's no other question. So if there's no other question, thank you very much. Like I said, I'm going to share the model, the template with you, both the blank and the completed template. So you can, on the blank template, you could customize it based on if you want to produce a lease model for maybe you have in your office or maybe in for exam purposes or learning purposes. I'm going to share it with you. So thank you very much for your time. Please do me a favor. We need feedbacks as usual. Please, on the WhatsApp group, please drop a feedback. Let me know how today's class was. Please just drop a feedback, a sincere feedback about today's class. The feedback helps us to know how we can improve our lectures, our subsequent lectures, and deliver better in the near future. So thank you very much. Please endeavor to drop as many as were in the class today. Please drop a feedback for me. Let me know how the class went. Thank you very much, everybody, and have a good night rest. I'm ending the call now. Thank you, everyone.
Thank you, sir.
Thank you.